Welcome to Lecture 6. In this session, we'll take a deep dive into the world of interchange fees and explore the different pricing models used by payment processors. These fees and models determine how much merchants and consumers pay for transactions and are essential to understanding the overall cost structure in the payments ecosystem. By the end of this lecture, you will understand what interchange fees are and how they work, identify the key parties involved in setting and collecting interchange fees, explore different pricing models used in the payments industry, including interchange plus and tiered pricing. Learn how interchange fees impact businesses and why understanding them is crucial for merchants and payment service providers. What are interchange fees? An interchange fee is the fee that a merchant's bank, the acquiring bank, pays to the cardholder's bank, the issuing bank, when a credit or debit card transaction is made. Essentially, interchange fees cover the costs associated with processing card transactions, including fraud prevention, risk management, and network maintenance. Key definitions: issuing bank, the bank that issued the card to the consumer. Acquiring bank, the bank that processes the payment on behalf of the merchant. Interchange fee, the fee that the acquiring bank pays to the issuing bank for each card transaction. How interchange fees work. When a consumer makes a purchase using a credit or debit card, the process behind the scenes looks something like this. Purchase initiation. The cardholder swipes, inserts, or taps their card at a merchant's point of sale, POS terminal, to make a payment. Authorization. The acquiring bank requests authorization from the issuing bank to approve or decline the transaction. Transaction approval. Once the transaction is authorized, the issuing bank charges the cardholder's account for the transaction amount. Interchange fee deduction. The acquiring bank pays the issuing bank an interchange fee for processing the transaction. Merchant payment. The acquiring bank deposits the payment into the merchant's account, but it deducts the interchange fee and other processing fees before doing so. Example: let's say you buy a $100 pair of shoes at a store using your credit card. The acquiring bank charges the merchant $3 in total processing fees, which includes an interchange fee of $1.50 that goes to the issuing bank. The merchant ends up receiving $97 in their account for the transaction. Key players in the interchange fee process. The key players involved in the interchange fee process include issuing banks, banks that issue credit and debit cards to consumers and receive the interchange fees from acquiring banks. Acquiring banks, banks that process card payments for merchants and pay the interchange fees to issuing banks. Card networks. Networks like Visa, MasterCard, and American Express facilitate transactions and establish interchange fee rates. Merchants. Businesses that accept card payments and pay processing fees, including interchange fees, to the acquiring bank. Why do interchange fees exist? Interchange fees exist to compensate the issuing bank for the cost it incurs in providing payment cards and processing transactions. These costs include transaction processing, the cost of handling and securing each transaction. Fraud prevention. Issuing banks invest in fraud detection and risk management tools to protect cardholders and merchants from fraudulent transactions. Cardholder rewards. Many credit cards offer rewards programs, for example, cashback or points, and interchange fees help fund these programs. Factors that influence interchange fees. Interchange fees are not one size fits all. They vary based on several factors. Type of card used. Different card types, for example, credit, debit, rewards cards, have different interchange fees. Credit cards generally have higher fees than debit cards. Merchant category. Certain industries, like airlines or grocery stores, may have lower interchange rates due to their high transaction volumes. Transaction risk. Transactions deemed riskier, for example, online or international purchases, typically incur higher interchange fees due to the greater likelihood of fraud. Payment method. In-person, card-present transactions tend to have lower interchange fees than card-not-present transactions, for example, online or phone payments, because they carry less fraud risk. Transaction size. Higher value transactions may have lower percentage-based interchange fees, as the fixed cost per transaction is spread across a larger amount. Types of pricing models in the payments industry. There are two primary pricing models that acquiring banks and payment service providers use to charge merchants for processing transactions: 1. Interchange plus pricing. In the Interchange plus pricing model, the merchant pays the interchange fee set by the card networks, Visa, MasterCard, etc., plus a markup fee charged by the payment processor. Example: interchange fee 1.5%, processor markup 0.5%, total cost 2% per transaction. Advantages: transparency. Merchants see exactly how much of their fees are going to the card networks, interchange, versus the payment processor, markup. Customization. Merchants can better understand their costs and negotiate lower processing markups. Disadvantages: complexity. Since interchange rates vary based on factors like card type and transaction method, merchants may need to track numerous rates and fees. 2. Tiered pricing. Tiered pricing is a simplified pricing model where the payment processor groups transactions into different tiers based on risk and assigns a fixed fee to each tier. For example, qualified rate, low-risk transactions such as in-person card swipes, 1.5%, mid-qualified rate, medium-risk transactions such as manually keyed-in cards, 2.5%, non-qualified rate, high-risk transactions such as online or international payments, 3.5%. Advantages: simplicity. Merchants don't need to track different interchange rates and markups for each card type or transaction method. Predictability. Tiered pricing makes it easier for merchants to predict their processing costs. Disadvantages: lack of transparency. Merchants may not see the exact breakdown of the interchange fees they are paying, leading to higher hidden costs. Higher costs for certain transactions. Tiered pricing often results in higher fees for riskier transactions. 3. Flat rate pricing. In flat rate pricing, merchants pay a fixed percentage for every transaction, regardless of card type or risk factors. This model is commonly used by payment processors like Square and PayPal. Example: flat rate 2.9% plus 30 cents per transaction, regardless of card type or risk. Advantages: simple and predictable. Merchants always know what they will be charged for every transaction. Ideal for small businesses. Flat rate pricing works well for businesses that process a low volume of transactions. Disadvantages: potentially higher costs. Merchants may pay more in processing fees for low-risk transactions compared to other pricing models. How interchange fees impact merchants. Interchange fees make up the bulk of a merchant's card processing costs. These fees are ultimately passed on to the merchant and indirectly to the customer through the prices of goods and services. Challenges for merchants. Profit margins. High interchange fees can significantly eat into a merchant's profit margins, especially for low-margin businesses. Pricing strategies. Merchants may need to adjust their pricing strategies to account for interchange fees, especially when offering discounts for cash payments or charging higher prices for card payments. Customer behavior. Some merchants may offer incentives, like discounts, to customers who pay with cash, helping the business avoid interchange fees altogether. Solutions for merchants. Negotiating with processors. Merchants can negotiate lower processing markups or explore alternative pricing models, for example, Interchange Plus, to reduce costs. Surcharge fees. In some regions, merchants are allowed to pass interchange fees onto customers as a surcharge for using credit cards. However, merchants need to be aware of legal restrictions surrounding surcharge fees in different locations. Cash discounts. Offering discounts for cash payments can encourage customers to avoid using cards, reducing interchange fees for merchants. The future of interchange fees and pricing models. As the payments industry continues to evolve, interchange fees and pricing models are likely to see significant changes driven by technological advancements and regulatory pressures. 1. Real-time payments and lower fees. Real-time payment systems like RTP in the US or faster payments in the UK could eventually reduce reliance on card networks, lowering fees for merchants. These systems are likely to grow in popularity as they offer faster, cheaper payment alternatives. 2. Cryptocurrency and blockchain. Blockchain-based payment systems and cryptocurrencies may offer an alternative to traditional payment rails, allowing merchants to bypass card networks and their associated fees. However, these technologies are still in the early stages of adoption. 3. Regulatory changes. Governments and regulatory bodies may continue to impose caps on interchange fees to protect merchants from excessive costs. For example, the Durbin Amendment in the US imposed limits on debit card interchange fees benefiting merchants. Key takeaways. Interchange fees are paid by acquiring banks to issuing banks to cover the costs of processing card transactions. These fees are a significant part of the overall cost structure for merchants accepting card payments. Different pricing models, for example Interchange Plus tiered flat rate, allow merchants to choose how they pay for payment processing. Technological advancements and regulatory changes may shape the future of interchange fees, potentially reducing costs for merchants. That wraps up Lecture 6 on understanding interchange fees and pricing models. If you have any questions or need further clarification, feel free to reach out. See you in the next lecture.